None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Sorry about that little sound difficulty. We should be fine now. Good morning. I hope everyone had a good weekend. This week we're going to be doing 3 of these shows. We're going to be doing one today, Wednesday, and Friday. And then we're also doing a Process Warriors on Wednesday. I believe we're going to do it at 3 o'clock. We'll be announcing that after this meeting today. That'll be just one meeting this week, and there'll be more coming next week as we start to bring in more of the training element and perspective and building portfolios and other things using VPM. This week has the possibilities of just being a completely, I guess, insane is the best word. There's so much news coming out this week. There's economic news. We've got the FOMC meeting. We've got the Ukraine hanging in the background. Everybody's nervous about something, no matter who you're talking to. And the markets are acting that way. We saw a brief rally this morning, trading up to some extremes, and then we've already pulled back. Today, as usual, we're going to go through the market trends. We'll talk about some of the things that I discussed in the commentary for Monday. And then we'll go through the treasuries, the dollar. We've got a couple stock of the day that I think will be interesting to go through today because there's quite a bit of stuff going on out there with the earnings continuing. So let's go ahead and go to the markets to start. And as we come into the market segment here, I want to bring up just the futures markets for the moment. One of the things that I'm seeing here is we just hit a cycle low in a 5-minute chart. Let me bring that up so you can see this here, and you'll see these cycles. One just hit a minute ago as we were printing down into the lows of the session. So we'll see how this plays out. But certainly there's about another hour and a half before another one of these cycles will hit. The patterns that continue to unfold are very choppy. They're indicative of the sideways trend that we've been locked in for. It's getting to be almost 10 weeks now. We're not really going anywhere at all, and it's pretty frustrating. Meanwhile, we're seeing VPM continue to pull back a little bit on the percent bullish and start to adjust some risk in most of our portfolios right now, which makes sense considering we're at historical highs and the trends are starting to fail. Now, whether they resume or not and we go back up, that's yet to be seen. At that point in time, then we may have to come back into some of those assets, but we're most likely, as I've been talking about for a while, I think there's going to be a top here in the Q2, and there's certainly a lot of things to point at. And just to continue a little bit of talk here, is one of the things that is happening in the fundamentals. It appears that most market participants, you turn on CNBC for a few minutes, listen to one or two guests, you'll hear that what they're really talking about is how earnings and everybody's upping their GDP and all of the estimates are going up and the economy is going to continue to improve. Maybe there's a little tick better. Well, that doesn't always necessarily equate into a stronger stock market. A lot of times we start to get in, we'll see this normalization, maybe interest rates start to turn. Like if you recall, and we'll go through it a little bit today just as a refresher, that there are some things going on with the treasuries once this particular sequence gets done, that we're going to see the market start to turn back higher again, and we're still trying to figure out what the puzzle looks like as we go down the road. So as we look at the 5-minute chart here, you see, as I mentioned, we just came into a cycle low. If I'm going to go back and we're going to look at the, and once again, these are the futures, and I discussed this on Friday, so I want you to see this. One of the things that happens, if you see these ribbons that I have on here, during this uptrend, the market was trading through the ribbons. Now we are trading below them. And it's not likely that this market's going to hit an ultimate bottom until we see these ribbons come back in and they're flowing with the market, and then we'll see some crossovers and flattening and start to see a typical move within the minor trends. Now this is a 1-hour graph we're looking at on the futures, and it's also a 24-hour graph that we're looking at. So there's not a lot to be determined from this other than the very short-term trends. We are seeing some spikes happen. If you notice this indicator at the bottom down here, I'll go ahead and bring the whiteboard up just for a minute because I want to cover a couple elements here that I think are significant from that standpoint. And this will show us where the spikes come in at. If you notice, I've drawn a couple small arrows here, and this coincides with this move up at the top here. We saw a reversal in the last couple hours, and now we're seeing finally to see some prints. You can see typically when we get to a extreme, drawing another arrow over here, when this extreme printed, you're usually at some sort of change in the market or some sort of hesitation that's going to happen from an intraday standpoint. Now none of this really matters from us from using VPN, but it does help you folks to understand what's going on with the markets on a smaller level. So let's go to look at some of the longer term charts, and I think this going through the S&P trends quickly here, I think this is pretty interesting. I'm actually just for a second here going to I'm going to format a couple things here. I just want to get a better view of this chart. What I have at the bottom now is the VIX, is the orange at the bottom, and I've cleaned off some of the other indicators for the moment. Excuse me. And what we're looking at here is the VIX actually came down right to the 13, the high 12s again. Now we're back at the 1460 level. We're starting to see this thing increase. But what's happening is this trend, we saw two spikes here going. So let me show you where I'm talking about here. There's two spikes right here in the VIX, which equate up here to the two weekly spikes that we saw in price. So 4 weeks ago we saw that big drop. We saw a reversal last week, and now absolutely no follow through. The VIX is starting to increase again. It looks like we're probably going to try to break through some of these moving average bands and these linear regressions that I have here. This is most likely going to continue to set a tone for more sideways and maybe for more of a broadening top type formation, but we're definitely not going through the top at this time. We're definitely not going to rally much, and this is what I continue to talk about. I know this is really boring. I remember going way back in 19, I believe it was 99. I used to do a review of the bond market, and the bond market went into a flat line. It was like a completely a flat EKG almost. It wasn't going up, it wasn't going down. It was very, very boring, and it lasted for about 7 or 8 months. So I don't have no idea how long this particular pattern is going to elongate before we finally get some movement out of here. But certainly there's enough, I guess, uncertainty or questions up in the air for economically that folks are trying to see what's going to be next. And I doubt very much that Janet Yellen is going to give us much to go on from that standpoint. I don't really see her giving us a lot this week. She's not really done a very good job so far, at least a mixed job as far as communicating what's going on with the markets and with the Fed policy. It's just very difficult for anybody to get a handle on what's going on right now. We get the new Fed change. I've talked about what happens when we have a Fed chairman change. Usually within a year's time, there seems to be some significant events, and all of them that I can recall, going back to Greenspan in 1987 crash, and then going into Bernanke and other elements, they've all been negative. Now, maybe that won't be the case. Maybe we'll navigate through this, but there's certainly a lot to be concerned with. $17 trillion plus deficits. You've got all types of borrowing needs. I've said for years it takes one bad auction for the market to roll over and hit a pretty big snag. The Fed is continuing, as we know, the QE, and just talking a little bit about Yellen here for a minute, is they're trying to change the narrative a little bit. The narrative is starting to change from a QE or quantitative easing to more of a qualitative type situation, trying to control interest rates. They're trying to change that narrative, and we'll see if they can do it very successfully. But a lot of what the Fed does most of the time is posturing of their voice. And excuse me, I've got some funk that's been going around the valley, so I'm at the tail end of that. So if I have to clear my throat, I apologize up front. But the whole situation with the Fed is continuing to be, in my opinion, setting more uncertainty than certainty, and that is going to give market sentiment the ability to change on a dime, and I think it could get pretty negative. Most of the portfolios we have out there are 50-60% invested, which I think is fine. I don't see, we've adjusted risk quite a bit. I don't see there needs to be a lot more done from where we are right now, because the fact that there's perceived uncertainty is one thing versus true uncertainty. And we do have the geopolitical risk that we've discussed with the Ukraine, but no one knows where that's going. So the weekly graph here that we're looking at, just going back to this pattern, this is starting to show signs from my viewpoint that we're getting close to a further rollover. Let's take a look at the short-term graph just for a second here. And you'll see it's also showing sort of a rollover. As I mentioned before, these are the webs that you see right here, these regression lines. This is it's starting to show the type of action that you get at a top. At least we're going to retrace potentially back into the numbers that I mentioned last night in commentary. We're at the 1828, 1817 is a possibility. I'll continue to harp on about this 1795 pivot zone. As long as we stay above that, longer term we're going to be okay. Intermediate term just continues to be really choppy and directionless. And probably what you're seeing from your portfolios is profit taking on a lot of positions that have been on for a while, and some of the positions maybe that haven't worked out that have come on in the last 6, 8, maybe 10 weeks. You might see some rotation out of some of those. It's a very typical action that we're seeing here from the way the models are acting relative to the type of action we're seeing in the markets here. You can see here, once again, it's interesting though that the PPM1 is actually showing a 0.26. If you recall, the PPM, anything greater than a 0.25 suggests that there's a trend going on. And let me look and see what this value is here just to give you an answer. The value for this is 1863.34. We're trading right on that average right now. There was an event that happened earlier this morning I want to talk about. We have two things we put out. We put out the daily support and resistance numbers. We also put out some weekly numbers. And the first resistance number was 1874.20. That number was reached. We saw a high intraday of 1877.01, so we exceeded a little bit. We saw almost an immediate reversal, and now we're trading down toward the lows of the session at this time. Market's basically flat, and we're seeing not a lot of participants running in there ahead of the Fed, ahead of this monster amount of news that we have coming on. I profiled those in the commentary last night. There's a ton of stuff coming out, and many of them significant, or at least sentiment changing. There's quite a bit going on. So I'm expecting that we're going to see some pretty good volatility. If we can break through some of these numbers here, there's a couple numbers. On a short-term level, this 1860 level is going to be key, just below where we are right now. And if we get below that, then we're going to start to see the market flow toward the lower end of the, if you recall, the trading range I've talked about is 1841, 1882. So we saw us trade 77. Now we're back into the 60s, and we could see another 20 handle move. Maybe before the Fed. We'll see how everything plays out at that time. So let's go on. Let's just take a look on an intraday basis what's going on. This is a real short-term chart. This is a 1-minute graph looking at the futures, and you can see we bounced off the lows pretty good right about the time that 5-minute cycle came in. So we're seeing a definite move here. The last 8-10 minutes we've been able to bounce off of the low after retesting the lows at this level. So we're definitely seeing some improvement off of the lows. As I said, we're flat on the day. We're continuing to see a massive amount of move on the downside on NASDAQ. The NASDAQ's down 23 handles right now, which is just seeing a lot of pressure. And once again, techs, biotechs, all of those that we've been talking about continue to drive the NASDAQ lower. And sometimes you'll see markets trade like this where you have one of the three popular indexes start to show some characteristics that the others are not, and we'll find out whether the S&P will be able to follow on the downside or what's going to happen here. But there's definitely some continued pressure as we see some rotation going on in the markets, and that's part of what continues to happen here. But this is just showing the rebound that we had off the lows. You can see over here on the far right, we printed down to 1855.25. We're currently 58.75, so we're about 350 points off of the lows right now from the standpoint of the futures, and we're back to unchanged on the day. And as this market's unfolding, we're continuing just to see a sideways back and forth from an index standpoint. One of the things I want to go through as we're going through the trends here, and I want to see if we can make this just a little more view here. A couple things I'm going to take off here just for making it easier to see what we're looking at. This will clean up the chart quite a bit. We are seeing it. You know, I've got IBM up here, so it will really help if I get to the right chart. I apologize. I thought this doesn't look like the index that we're looking at. So we're going to go back and clean this up. So here's a little better view of the index. You're starting to see this on this is the hourly. So we'll go to the daily. The daily, we're seeing this is the improvement on the PPM1, which shows us that short-term trend that I was talking about. you'll see right here where I've drawn an arrow, and this, even though the market is pushing the lower end of the range, we're still positive on a day. We're still seeing some positive output here. 0.26, as I talked about earlier. The PPM2 is 0.4, which is flat, and the PPM3, which is tied to the 40 period moving average, is currently at 0.072. So it's almost exactly flat. So they're positive numbers, but not by much. And so what we're seeing here is some support at this 1864 number, which is where we're trading right now. 1864.30 is the current 10 period moving average. So that's going to represent a support level. As I mentioned in commentary last night, the critical level intraday today is 1860.45. If that were taken out, then we'd start to see the market roll over pretty good. So the patterns that are unfolding short-term wise are in sync with what we're seeing on the intermediate. So let's go over and look at the weekly, and then we'll go out to the long-term charts just to show that. I want to clean up one last thing here. Something else that happened, just to discuss that, is the 3-day range indicator. We're back to around 12. We got down to below 9 the other day, so we started to see a little more volatility come back into the market, but not a lot. And we've already satisfied the daily range. So my guess is we probably have seen the high and possibly the low of the session. There could be some other pressure coming in later in the day. I believe most of the news is out right now that we had coming out today. So market sentiment will be affected by outside news factors, and I believe it's getting late night in the Ukraine. There's probably nothing going to happen. That's probably beyond us as well. So, but as we look at these weekly patterns, we're continuing to see virtually a flat environment. I just don't, wish I had more. I wish there was something going on in the marketplace that was going to show us. But once again, PPM, the 10-week moving average, 0.15, were exactly the same on the PPM2, which is 0.15, and then we've got a little more robust environment underneath there, going down to the PPM3, which is tied to the 40-week moving average, which is synonymous with the 200-day. If you think about it, 40 weeks has 5 days in each week. It's just a slightly different calculation. I've used the 10/21/40 since the 1983 as main indicators for me understanding trends. So folks talk about the 200-day. The 40-week for me is a similar number. And so we've got pretty robust numbers underneath here. We're not really, as I've discussed before, we're not at that point where this market's likely to break down substantially. So the sideways trend is going to be with us. But every week that goes by, you can see right here, every week that's going by, we're starting to see this momentum flat, and we've been flat on all of these indicators, drawing arrows through there. We've been flat for a while. So this is really typical in these phases of the trend that we're at, but the market continues to grind. So if you think about it, with a 50-60% percent invested in your portfolios, you're still able to participate. From an index standpoint, you probably have a beta less than 1. From a stock portfolio standpoint, you probably have, if you have at least stocks that are a beta of 1.2 or greater, like we've usually suggested you have, even though you may have 60, maybe 30 to 40% in cash, you still have a little beta. You're still going to participate, if there is any upside, quite a bit. The interesting thing is the fact that VPM is trend following, and the items that it holds, there are relative uptrends that are unfolding on the things that we're owning, that they typically don't go down as much when the market does have some negative impact. And once again, sideways is the theme for the week, and for this month has certainly been the case. Let's go over and a final trend view, looking at the longer term, going over to the monthly graph. We are minutes from completing this on Thursday. Actually, Wednesday's action will set the tone for the monthly graph. If you recall, I discussed this the other day. We have an outside bar working where we made a new high in April and we made a new low from the previous month. And what this tells us is that we're have a potential for the market to generate an outside reversal bar, and to do it on a monthly graph would be pretty substantial. Not necessary, but let's take a look at a couple things here. And I think I'm going to do another little segment real quick while I have the monthly chart in. I'm going to talk about how the PPMs acted throughout the cycle. And we're going to go back further in time. I can go back, if I go to the Dow Jones, I can go back to the 1900s. But in the S&P, we can go back into the 80s, maybe even the 70s. And you can see that these things are pretty consistent as we go through them. But let's take a look at the current activity. I'm going to take and blow this up a bit so you can see this last bar. So where would we need to close to signal a reversal pattern? And it would be a close below, interesting enough, 1865.97. So we are trading at the key level 1863.09 right now. We are trading right at the level, if we were to close here, would be enough to signal a bit of a reversal. Anything below this, certainly if we were to trade down to the 1840s, is going to give us more of a pattern that we can deal with from the standpoint of looking at a reversal pattern. So this is a pretty critical month, to say the least. We saw a reversal a couple months ago, outside reversal. Was an outside reversal up that happened at a high, and those typically don't last for more than 2 or 3 bars. So it doesn't matter to me whether or not we have whether or not we have, a big reversal here or not. It does appear, once again, if you look at some of the other things that are critical here, that it does appear that we have some areas here to be concerned about. But as I mentioned several times, I know this may be getting redundant on the show, but I think it's important, if you're going to go through and do an incremental review and update, it's important to cover this stuff. And what we're seeing here from a trend standpoint right now, what we're seeing is a continuation of a pretty robust trend. And it's interesting, at least from my viewpoint, since I'm used to watching these numbers, as we're looking at the 2 arrows I just put in, PPM 1, which is tied to the 10-month moving average, which is similar to the 40-week, by the way, is up 1.47%, and the 21-month is up 1.43%. And these are pretty robust trend numbers. I've talked about this before. One of the things that happen during trends is the moving averages spread out, whether it's up or down. When they get to this spread mode, they're in their ultimate phase where they're about to roll over. So they're getting to an extreme right now, and we're just waiting to see how this thing is going to roll out at this time. But there's enough support under the market that suggests that the market's going to be able to support at different levels. So let's look at what those levels are here. And the 21 or 10-month moving average is 1778. The 21 is 1633. So if the 10-month over the next 2 months would continue to flatten out, we could trade down to below the 1795 number that I've talked about, trigger a high, and then we could roll down and see some momentum fade off of the 10-month moving average over the next, it looks like, let's say, the dog days of summer through the summer, and we would come into probably a more probability of any sustained decline of any sort down to sometime in maybe in the fall, September, October, we might see the move happening at that time, just looking at these monthly bars. And if that were the case, we'd probably trade down to the 21 period moving average on a monthly basis, which coincides with the numbers I talked about in the outlook, which would be around the 1640 level. That's not a really big decline, but it is about 10 or 12%, I believe, if the numbers are right. Maybe 8 to 12. I'll have to look that up and see if we can see what that decline would be to go there. But the bottom line is still not the big monster decline like we had in '08. It's not the 2000 rollover. That's not where we are right now in the marketplace. But we are at a point where there is risk starting to show up. Let's go next, and pretty good coverage of what's going on with stocks. Let's go ahead and let's start to look at let's go look at the 10-year note here. And we're starting to see a slight, this is the daily, we're seeing it move up to the 269, almost 270 level. And this pattern suggests that the downward motion that we saw in interest rates last week, in the last 2 weeks, is probably completed. There's still some consolidation. I want you to look at the same trends. One of the things that I hope to achieve here on this show is for you folks to understand more about the type of analysis that's being done. And the software is programmed to do all this stuff for us. So I'm just bringing you into the laboratory to show you what these indicators are doing. And we're continuing to work on a project we've had some requests about folks wanting to maybe get the logic for TradeStation. We are working on that. There's a couple things that we have to do to be able to make that happen, and that is being worked on. But this pattern that we're seeing here is potentially, and I've talked about this, potentially what I've just drawn in is a sort of a cup and handle, like it's called in a technical world, or a right shoulder. So if what we've seen in the initial decline, which would be the lows right here, if that was the low of this pattern, which puts us down around the 260 level, and then we've moved up, and now we start to move up. You'll notice that I pointed 3 arrows down to the PPMs here, and what those have done are actually showing that they're starting to show an increase of upward pressure. The PPM stand for price pressure momentum, and we're measuring the angle of attack of these moving averages, and they're starting to show. Now this is a daily graph, so it's very short term, so this isn't the big move. We'll go to the weekly here in a minute, but this is important to understand exactly what's going on from the standpoint of the minor trend that will develop into more of an intermediate trend. So let's go ahead and look at the weekly trend in the interest rates. And you can see we've talked about this before as well. We're continuing to see this unfold in the same method. We've got a complete flat channel here. And I took off the Fibonacci calculations for the targets, but if I can bring them up. But we're looking at 340, 380 up here for it moving up through this pattern. We're seeing we have positive numbers, 0.14. The 21 is still negative at minus 0.32, and the 40-week moving average is now a positive 1.2. And when you get a mixed picture where you have a couple up and one down, we're still in the process of setting up the larger pattern. And right now, there's no indication on the intermediate basis that we're going up or down. It is also neutral, but it won't take much to trigger this uptrend, and I suspect we will see rates go up. And that's really the big puzzle that needs to be figured out, is what does this mean if rates go up for the stock market? Is it negative or positive? And I'm working on that equation right now. Still need more of the picture to make the determination. That's why we have VPM, where we've adjusted risk at these levels, so there appears to be a risk showing up. That's why we've been scaling back the bullish percent. And from the standpoint of the models, they're seeing a lot of failures of trends. That doesn't mean that these particular items are going to go down. They're just not going up. And if you recall, the whole concept here is if it's not going up, I'd rather be in cash and protect that asset than hoping that it might go up, and there's risk that trend may change. So interest rates are pretty much what they are. Let's go over and take a look at the Dow index real quick, and then we're going to move on to some of the stocks of the day here. So here we are, the Dow. It's about as boring as the rest of the markets. Right now, we do have a buy in this pattern that's being generated. I believe. Let me just look and see what model's on here. Yeah, this is 1.2 model that's on here right now. So it is long. I'm not positive that. I believe this is the optimized model for this particular one, but this is the weekly. So we're continuing sideways. We're not going to find anything, but